Operating leverage. Operating leverage is defined as the firm's ability to use fixed operating costs so that effects of changes in sales on its earnings before interest and tax is overstated. Please note EBIT is earnings before interest and tax. In other words, with fixed costs, profits and changes that are felt in profits with an associated change in the volume is considered greater than the percentage of change in volume. In simple terms, operating leverage is the extent to which a firm can increase its operating income or operating profit by increase of revenue. The key in firms with high gross margin, low variable costs generally tend to be with a higher operating leverage, and the firms with low gross margin and high variable costs tend to be with a lower operating leverage. The formula to calculate operating leverage is contribution margin divided by profit. That is the formula which we use to calculate operating leverage. In other words, the formula for operating leverage for a product-based company is stated as what is given here. So first is degree of operating leverage is the product of Q into CM. CM is price minus variable cost minus variable cost per unit divided by Q into CM, where Q is the quantity in units into CM. CM is the price minus variable cost minus fixed operating costs. So the division of this gives the degree of operating leverage. The formula for a firm may also be stated as degree of operating leverage is DOL, which is change in EBIT in percentage divided by change in sales in percentage. And this has to be greater than 1 if the degree of operating leverage is acceptable. So earnings before income and tax, the change in EBIT in percentage divided by change in sales in percentage. Degree of operating leverage is also delta of EBIT. What is delta of EBIT? Which is the change in quantity and it is multiplied with S minus V, where S is the selling price per unit and V is the variable cost per unit. So that is delta EBIT, which is divided by EBIT, which is the quantity into selling price minus variable cost minus fixed cost. That is it, and that is EBIT. So the delta, the percentage change in EBIT with respect to EBIT is divided by percentage change in quantity with respect to the quantity which we have. So that is the formula where EBIT, the degree of operating leverage is calculated based on EBIT. What we'll do is we'll take a look at an example to illustrate this further. Also note that operating leverage exists whenever there are fixed operating costs. If there is no fixed operating cost, operating leverage will not be there. So let us take a look at the example. So this is an example for illustrating operating leverage. Here what we have is a firm sells products at rupees 100 per unit. Variable cost is rupees 50 per unit. And fixed operating cost is rupees 50,000 per year. Now we want to find out the various levels of EBIT when sales is 2,000 unit, 4,000 unit and 6,000 unit. So here you note that there is a difference of 2,000 between the sales volume. That is 2,000 units, 4,000 and 6,000. So there is a difference of 2,000. So what we do is we take a base quantity of sales as 4,000 units so that we have a set of values for 2,000 lesser as well as 2,000 more. So the base we will take it as 4,000. Now we'll see how we work out the problem. We want to find out EBIT, various levels of EBIT. Okay. So what we have is sales in units. We have for the base it is 4,000. Sales revenue. Your cost of one unit is 100 per unit. So it is 400,000 or 4 lakh is the sales revenue for the base. Variable cost it is 50 rupees per unit, which means there are 4,000 units. So 50 rupees per unit, it means variable operating cost is 200,000 or 2 lakh. The difference between sales revenue and variable operating cost is the contribution, which is 200,000 or 2 lakh. And from this, fixed operating cost is deducted, which is 50,000. So which means the EBIT is found out, earnings before interest and tax is found out as 2,000 minus 50,000, which is 1,50,000 or 150,000, which is the EBIT for base. Similarly, for case 1, we find out EBIT to be 2,50,000. And for case 2, we find out the EBIT to be 50,000. Now we'll examine what is the degree of operating leverage. Even before that, we'll see there is a significant difference in earnings. From the base, whenever the sales in units are reduced by 2,000, there is a significant reduction in earnings before income and tax, which is 50,000 only. So from 150,000, it has gone to 50,000. Similarly, when the sales is increased by 2,000, that is from base 4,000, to case 1, it becomes 6,000. So that is the sales volume, which when it is increased by 2,000, the increase in EBIT is felt as 1 lakh or 100,000 from 150,000 to 250,000. So there is a significant increase in earnings before interest and tax whenever the sales volume goes from 4,000 to 6,000. So the degree of leverage is, when you consider base as 0, for an increase of 2,000 in the sales volume, the degree of operating leverage is 1.33. And for case 2, it is 4 or minus 4. So EBIT is 33.33% lesser for case 2 and 66.66% more for case 1. So applying the formula DOL, which is degree of operating leverage, which is change in EBIT in percentage by change in sales in percentage. That is what we apply to get DOL. So change in EBIT per percentage we apply, which is from 150,000 to 50,000 for case 1, which is 100,000. And this is divided by change in sales in percentage, which is that change I talked about, from 4,000 to 2,000. When you apply that, we get degree of operating leverage as 4. So in case 2, it is the degree of operating leverage is 4, and in case 1, the degree of operating leverage is 1.33. This example, you can take a look at, it will be in the reference sections. So we can take a look at that. All the time you have to keep in mind that whenever there is a change in sales volume, there is a subsequent change felt in earnings before interest and tax, as well as the degree of operating leverage. Thank you.